Earnings boost Europe's markets, but nerves over inflation refuse to go away. Welcome to Market Insight. I'm David Pollard. Quarterly earnings reports from big names like ASML, LVMH and Adidas in the spotlight today, as was Jerome Powell on Tuesday. The Fed chief warning that strong US data may mean tight monetary policy may stay in place for longer. This before today's data showed UK inflation falling, but perhaps not as quickly as the Bank of England would like. Well, for some expert insight, I'm joined by Swetha Ramachandran, Global Equities Fund Manager at Artemis. Many thanks for joining us, Swetha. LVMH first, its results greeted as perhaps not so bad after all, but what about the rest of the sector where share prices have been sold off dramatically this year?
Indeed, I think the sentiment post LVMH has really been one of relief, but should it be uniform across the sector? I don't know, given that there's clearly polarization emerging where some brands are doing much better than others. And I would put the LVMH stable in the camp of the winners rather than the losers. So perhaps it's unfair to extrapolate that the rest of the sector is out of the woods just based on these numbers alone.
Now, China has been a factor weighing on the outlook for luxury stocks, but it's been less of a concern for chip equipment maker ASML than feared, that despite US-led export restrictions. But its shares are struggling today, so what do investors not like and what they've seen in today's results?
It mostly appears to be a timing issue where the phasing of the booking of the new orders has been weaker than expected in the first quarter. China, as you point out, has over-indexed as a proportion of where the revenues have been composed in Q1. And there are some indications that perhaps the Chinese are over-ordering ahead of the chip restrictions fully coming in, which are expected to affect about 15% of ASML's total sales. That said, the company does believe that it is on the cusp of a semiconductor upturn, which we're also seeing elsewhere, and that the second half of the year should bring about a cheerier outcome.
And then, of course, we've had Adidas today, which has raised its guidance, putting its shares at over 2-year highs. This is something of a turnaround, isn't it?
Absolutely. The shares have been really decimated in the last couple of years as a result of a few self-inflicted wounds related to inventory, promotional activity, but also the whole Yeezy controversy, which led to them basically abandoning their relationship with Kanye West. And they're now coming through the other end of that. And the big surprise from today's numbers was really the extent to which gross margins have recovered. And I think the share price reaction points to the fact that the market is expecting them to continue raising guidance as the year goes on.
Well, let's turn to the economy, Swetha. We've had UK inflation data today, inflation at 3.2% in March. That's not as low as hoped, in part due to stickiness in services prices. Why and how persistent is that problem?
There are really two elements of services that appear to be contributing to the sticky inflation. Firstly, lodging, and that has been quite a volatile time series. So overnight hotel stays, where inflation has been much higher than expected. But again, on a monthly basis, that has moved around quite a lot. So I'd be surprised if that doesn't come down in the next release. And the second has been communications, where again, after a lull in February, we saw this pick up again in March. The durability of both of those is in question, however, and it seems more likely than not that these are temporary phenomena that are keeping services inflation higher for longer.
So should we be recalibrating our expectations for Bank of England rate cuts on the basis of this data, or indeed any other data we've seen recently?
Oh, well, certainly markets have actually taken the chances down pretty immediately of rate cuts. It appears that the impetus for rate cuts is further away, not as immediate. So in fact, the market is only now pricing in one rate cut for the rest of the year and perhaps a 30% chance of a second rate cut. It almost seems inevitable that it will be delayed if it occurs at all to June or beyond, depending on how services inflation progresses.
And globally, should we be downgrading our central bank hopes after Jerome Powell's remarks yesterday and after strong US data? Are policymakers walking away from a rate cut in the months to come? And if so, what does it mean for their counterparts at the ECB?
It does seem as if central bank officials in the developed world are pouring cold water on the prospects for imminent rate cuts. Some of this is also geopolitically related, where tensions in the Middle East, for example, have had an impact on oil prices, which are up 20% year to date and is no longer contributing to disinflation as such. That said, we think that the path will remain data dependent, as the Fed has always said, and that possible core personal consumption expenditure inflation, which is due to come out in just over a week's time, could offer some hopes that at least one or two rate cuts are on the cards for the remainder of the year. It does seem as if the ECB is on a divergent path where they have committed quite recently to rate cuts being likely as early as June, based on what they see as a bit more slack, perhaps, on the disinflationary side, as well as on economic growth more broadly in the Eurozone area versus the rest of the world.
Okay, Swetha, it's been great to hear your thoughts. Swetha Ramachandran of Artemis, many thanks for being with us. That is Market Insight. Don't forget you can watch more videos on Reuters.com.